Welcome to the Pro Ticker Deep Dive. We are diving straight into what feels like a structural breakdown right at the heart of the American economy. Forget inflation versus unemployment for a second.
Right.
Because the real conflict, the real tug of war right now is between the Federal Reserve and Congress. The trillion-dollar question in late 2025 is, who's actually calling the shots?
And what's so fascinating here is that this isn't just a disagreement anymore. It's escalated into a defining structural crisis. The relationship between monetary policy, that's the Fed managing rates, and fiscal policy, Congress managing spending, it's showing real visible strain. Our sources are all saying the clean, predictable monetary story is it's over.
So our mission today is to really analyze that tension. You've got Congress needing vast amounts of cheap capital just to service its crushing debt load.
A scenario people are calling fiscal dominance.
Exactly, fiscal dominance. And on the other side, you have the Federal Reserve, which is trying desperately to maintain its independence, manage dollar liquidity, but without just pouring gasoline on the fire.
And we have to start with the sheer gravity of the fiscal problem. I mean, the numbers that set the stage for this are just staggering.
Okay, then.
By the middle of 2025, the national debt hit $36.7 trillion.
Wow.
And that number is climbing nearly 20% beyond the entire U.S. GDP. It's just an extraordinary level of leverage for any developed economy.
And to put that into a context you could really wrap your head around, the Treasury ran a deficit of $1.8 trillion in fiscal 2025.
Which is a number so big it's almost meaningless.
Right, so let's break it down. That means every single day, the federal government had to borrow roughly $5 billion.
$5 billion borrowed every day.
Yeah.
And that kind of borrowing, it has a structural consequence that's now boxing everyone in. Interest payments on the national debt, they've now become the third largest item in the budget.
Only behind Social Security and Medicare.
Exactly, the two huge mandatory spending programs. So that spiraling cost of just servicing the debt is now an economic driver in and of itself. It is forcing the Fed's hand.
Okay, let's unpack this then. The big event, the end of quantitative tightening, or QT. To really appreciate the magnitude of what the Fed just did, we should probably recap the last, 15 years or so?
Yeah, you have to. I mean, for years after the 2008 crisis, central banks kept rates at zero. They just inflated their balance sheets massively to keep markets stable.
And then inflation hit in 2022, and the Fed had to just slam on the brakes.
Absolutely. They raised rates aggressively up to that 5.25 to 5.50% range. And crucially, they started QT. This was a 3-year campaign designed to actively shrink that massive balance sheet.
Draining liquidity.
Draining about $2.4 trillion from the system at a clip of $95 billion a month. The whole idea was to, clean up the financial system's plumbing.
And then all of a sudden came this seismic policy shift. A shift that really proves the structural stress is now just too great. Tell us about that December 1st inflection point.
So on December 1st, 2025, the Federal Reserve just abruptly ended its 3-year quantitative tightening program. Stopped. Instantly halting the drawdown of its $6.6 trillion balance sheet. And this wasn't a planned exit. It wasn't, mission accomplished. Critically, this was not an action they took based on principled monetary policy.
So if it wasn't principled policy, you're saying it was triage. They were forced to act to stop a market breakdown.
That's it. It was triage.
But wait, isn't it the Fed's job to manage liquidity? If they're truly independent, why couldn't they just let rates rise a little and stick to their inflation mandate? Force Congress to clean up its own mess.
And that is the absolute core of the tension. Theoretically, yes, they should. But the sheer scale of government borrowing combined with thinning liquidity meant they were facing an immediate systemic seizure. The system was flashing red.
Okay, so give us the specifics. What were those financial distress signals in October?
The first big one was bank reserves. This is the high-powered cash banks used to settle up with each other. They slipped below $3 trillion.
Which is a key level.
It's a huge psychological level. It was their lowest point since January of 2025. You have to think of reserves as the system's buffer. When that buffer runs low, banks get nervous, they hoard cash, and lending just gets difficult and expensive.
And the second kind.
That was in the money markets themselves. The Secured Overnight Funding Rate, SOFR, which is the key rate for overnight borrowing, it started touching and even going above the Fed's upper rate bound.
So for anyone not in the weeds on this, when that overnight rate hits the ceiling the Fed sets, it's like a smoke signal.
It's a huge smoke signal. It means banks are desperate for cash and liquidity has suddenly frozen up.
And you mentioned they were using their backstops more often. That sounds a bit like the market having to use its emergency credit card.
That is a perfect analogy. We saw a rising use of the standing repo facility, the SRF, which is meant to be an emergency tool. When you see banks tapping the SRF regularly, it just confirms the whole system is too thin to handle the flood of new Treasury debt. The Fed had a choice: keep QT going and risk a full-blown funding crisis, or pump the brakes.
They chose triage.
They chose triage.
So here's where it gets really, really interesting. The perfect storm. You have this stressed financial system, and at the exact same time, the Treasury is just pumping out debt at a record pace. That $1.8 trillion we mentioned.
It's a classic supply versus demand imbalance, but it's being made so much worse by a retreating foreign buyer base. The perfect storm is that record Treasury issuance meeting reduced global interest.
And how significant is that foreign retreat?
Oh, it's very significant. China, for instance, holds only about $800 billion in treasuries now. That's down dramatically from its peak of nearly $1.3 trillion.
Wow.
And even Japan, which is still the largest foreign holder at $1.1 trillion, they're a reluctant buyer. They're very price sensitive. So when these huge international buyers step back, that debt has to be soaked up domestically.
Which means domestic banks, leveraged investors, they become the marginal buyers. And they need higher yields, and crucially, they need cheap financing in the repo market.
The very place the Fed's QT was squeezing liquidity.
It's a self-fulfilling cycle toward a seizure.
Precisely. Surging supply, retreating foreigners, thinning bank reserves, stretched domestic leverage. It's a recipe for dysfunction. And yet, despite all this, the 10-year Treasury yield, the benchmark rate, it just kind of oscillated between 4.0% and 4.1% in late 2025.
That stability feels so counterintuitive given the dire picture you're painting. What stopped yields from just shooting to the moon?
The stability comes directly from the psychological relief of the Fed's announcement. By ending QT, the Fed signaled, "We're done being a drain on liquidity." The market immediately priced in the expectation that the Fed would shift from a seller to a holder, and maybe even a net buyer of treasuries very soon.
And we saw direct evidence of that concern, didn't we?
We did. On December 1st, the same day, the Fed had to immediately reinvest $13.5 billion into the repo market. That just showed the underlying stress was acute and needed an instant fix.
Let's talk about a critical technical signal here. The yield curve. The 10-year to 2-year curve is positively sloped, but it's sitting at a really narrow 53 basis points. What did that narrow spread tell you?
It's a key technical read. The fact that the curve is normal, so positively sloped, that's good. But the narrowness is very telling. With this much debt risk, the market should be demanding a much wider premium for holding long-term debt.
Right. A bigger reward for the risk.
A much bigger reward. The fact that it isn't tells us that investors believe the Fed will keep things contained, either by providing liquidity or by eventually cutting rates aggressively.
So, in essence, the market has already decided. It's priced in that fiscal dominance will win out over the Fed's monetary independence.
That's the takeaway. The market believes the government's need to borrow will dictate the Fed's actions from here on out.
So this raises a really important question. What are the consequences of this policy capture? You have to look at this as a dual-edged sword, right? There are short-term opportunities, but also serious long-term risks.
Absolutely.
So let's look at the bright side first, the bull case for investors. If you're managing money, how does the end of QT and this implicit nod to fiscal stress actually help risk assets?
Well, the immediate short-term benefit is simply liquidity. The end of QT removes a major multi-year liquidity drain from the system that directly supports assets like equities and corporate bonds.
The Fed put is back.
The Fed put is firmly back in place. The market now believes the central bank will step in to prevent a major crash.
And the Fed acted devishly right after the pivot, didn't they?
They did. They cut rates by 25 basis points in December, and they're widely expected to cut further if growth slows. Why? Because they need to ease the pressure on the government's borrowing costs. It also helps that, as some of our sources noted, high tariff revenues, which hit $27 billion in July, offer a potential, if controversial, cushion that could reduce the deficit.
Okay, now for the other side of that sword, the bear case, where fiscal dominance threatens the whole system. What is the mechanical trap the Fed is now caught in? The one that threatens its own credibility?
The trap is, it's pretty straightforward, and it's why critics are screaming about policy capture. If the Fed simply reinvests the money from its maturing bonds, which they have to do to keep the balance sheet at $6.6 trillion, it is functionally bankrolling the government's spending.
Wow.
Strategists expect this to translate into about $35 billion in net purchases by the first quarter of 2026.
So the Fed is saying, we're just managing bank reserves, but what skeptics hear is, we're printing money to cover the deficit.
That's exactly it. And the moment investors realize this is a structural dynamic, that the Fed can no longer say no to the Treasury, confidence in its inflation-fighting credentials just erodes, their guidance becomes less credible, and crucially, inflation expectations could re-anchor higher.
And all of this is happening right as the U.S. government faces this just unprecedented wall of refinancing. How big is the debt coming due?
The maturity wall is massive. It really underscores why the Fed acted. The Treasury has $9.2 trillion in maturities by the end of this year, 2025, and another $9 trillion rolling over in 2026.
So they're just constantly reissuing debt to stay afloat.
Constantly. And this just accelerates the interest cost spiral because the average coupon on new debt is now 3.4%. The CBO projects that interest payments alone will reach $1.8 trillion a year by 2035.
That's almost the entire 2025 deficit. Yeah. Just on interest payments.
You're running just to stay in place.
So what does this mountain of debt and this perceived loss of Fed independence do to the dollar standing in the world?
Well, it creates significant dollar risk over the long term. If this perception of fiscal dominance spreads, foreign holdings of treasuries will keep dropping. Right now, foreigners hold about 32% of our debt. If that just drops to, say, 25%.
This isn't a huge drop.
Not at all. But the domestic market would have to absorb an extra $600 to $800 billion a year. And that's nearly impossible without yields spiking, which, again, accelerates the whole debt spiral. It's a slow erosion of the dollar's exorbitant privilege.
So what does this all mean for you right now? The bottom line seems to be that the structural inability to normalize the balance sheet while the government runs these huge deficits. That is the true inflection point.
Yes. The operational reality is clear. Fiscal dominance is here. The Fed is basically forced to maintain that $6.6 trillion balance sheet indefinitely to stop the markets from seizing up.
Okay, so from a practical market guidance perspective, what does living in this fiscal dominance world mean for the next, say, 3 to 5 years?
It suggests a very specific macro setup for investors. You're likely to see lower rates than the debt would otherwise justify, probably a softer dollar as global confidence erodes, and potentially higher equity valuations because the system stays flooded with liquidity.
Also, a bullish setup for growth stocks and emerging markets.
Exactly, things that benefit from cheap money.
And for our listener, what are the key indicators you need to be watching to see if this trend is holding or if things are really going off the rails?
I'd watch 3 things. First, the Fed's balance sheet. That $6.6 trillion level has to remain stable. Any real attempt to shrink it again will trigger immediate stress.
Okay, what's second?
Second, watch bank reserves. If they slip below $2.8 trillion, even with the Fed reinvesting, that's a danger sign yields could spike. If they get above $3.5 trillion, pressure is easing. And third, monitor the 10-year TPS spread.
Okay, explain that one for people who might not look at inflation-protected bonds every day.
Sure. The TPS spread is basically the market's expectation for average annual inflation over the next decade. Right now, it's around 2.31%. If that makes a sustained move above 2.5% and stays there, that's your signal.
A signal of what?
That the market's inflation fears are becoming real and persistent, and that they're being driven by this fiscal issue, not just temporary market noise. That's when a credibility crisis starts turning into an inflation crisis.
So the real long-term risk here isn't tomorrow's volatility. It's the gradual, decade-long erosion of the dollar's exorbitant privilege as foreign central banks just slowly back away. That's the slow burn.
That's the slow burn. And the actionable focus, for now, remains pretty consistent with this new regime. You probably stay long duration in bonds to capture those lower rates. You stay long the dollar, but only in a relative sense. It's still the cleanest dirty shirt. And you watch the Fed's balance sheet for the next signal.
Which is outright expansion.
Outright expansion. The moment they start actively growing the balance sheet again, not just maintaining it, fiscal dominance is fully priced in. And JP Morgan, for one, expects that to start by the first quarter of 2026.
See you all in the next Pro Ticker Deep Dive.